The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. What a day. What a week.
And the closing bell is about an hour away. Ding, 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 ding.
Ding, ding, big ding, because we are looking at a big rush to safety. We were running for cover all across the board in all the asset classes. You have the S&P down over 2 percentage points, tech getting wiped out as well. You have the VIX jumping, the VIX curve really distorted over in the last couple of days. The 2-year yield down 28 basis points. We haven't seen this move since the SVB crisis back in 2022. A huge move into safety, and that's permeating throughout all asset classes, Scarlett.
And what's driving it? A big miss. U.S. payrolls coming in below estimates of all but one economist that we surveyed here at Bloomberg. So now the debate is this a growth scare or something more? Either way, the Fed is getting blamed for not seeing this coming, which is why Wall Street is signaling to the Fed it is time to act with urgency. Economists at Bank of America, Citigroup, Goldman, and JP Morgan all revamped their forecasts, calling for earlier, bigger, or more interest rate cuts, maybe even before September. And Intel hits the reset button. The chipmaker gives a grim outlook, a sign of its struggle to compete in the age of AI. Intel must now slash jobs and suspend its dividend, leading investors to flee the stock and triggering another wave of the tech rout. Here's Bernstein analyst Stacey Raskin weighing in on the chipmaker's future.
They'll live, but what kind of a life it's going to be? I think that is the question that we're all wrestling with right now.
It's a different Intel entirely now, Alex.
A different Intel and a different market and a different economy right now than it was just 72 hours ago. And here's one big reason why. The white line here is what WIRP expects the rate to be from the Fed in December of 2024. So it basically takes into account how many cuts we're going to see through the end of the year. The blue line is the 2-year yield. They very much track each other. And now, as you look here, you can look at the bond yield just plummeting down to 3.87%. Again, we haven't seen that kind of chunky move in about a year and a half, or almost actually 2 years at this point. And the white line here then is where we're expecting rates to be. We're now pricing in about 111 basis points of cuts, give or take. And now the question becomes sort of how we wind up getting those cuts. Do we get a couple 50 basis point cuts? Do we get them as you pointed out, Scarlett, before the September meeting? But this is the story. This is the story. Bad news is bad news. Weak economy is here. That means lower yields and more Fed cuts.
All right, we'll put that all together right now and kick things off with Jeremy Siegal. He is Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania. Professor Siegal, it is always a pleasure to have you on the program. Clearly a very, very big week in terms of news. You had the Fed, you had big tech earnings, and you had the big jobs report. We're seeing stocks fall for a third day this week, with today's sell-off being the largest. Is this response an overreaction, do you think?
Not really. I think that Jay Powell wished his meeting was next week rather than this week. He certainly missed really bad data both on Thursday and on Friday. And I agree, he should have cut last time. And I do think that 4 cuts by the end of the year would be necessary, and maybe even more depending on certainly the evolution of data. The honeymoon is over. Let's put it that way. Jay Powell and Fed enjoyed this idea that we can bring inflation down, no real consequences. We can wait and wait and wait. Well, I think he waited too long.
But to put in perspective, Professor, I mean, it's not like we're bleeding jobs. The unemployment rate isn't near 5%. Does that really mean we need to see 27 basis point move on the 2-year, or 3% drawdown in tech stocks?
Well, and that's a recession fear, and certainly the tech stocks have very healthy PE ratios, as you know. Listen. Jay Powell had 75 basis point hikes. How many? 4 or 5 times. So, why should we be surprised at maybe a 50 basis point drop that he has? I mean, the Fed funds rate is 5.3%. The Fed thinks that the long-term normal rate is 2.8. nearly half of that. And we've come so far towards our target. I think that while the Fed hasn't moved a nickel towards its target, I think we see a mismatch there.
So what does that mean for stocks, Professor? Because we talk about the market pricing in at least 100 basis points of rate cuts for this year. But since that is already priced in, you'll need strong enough economic data and earnings to keep stocks rising. What is the likelihood of that happening given what you've seen in earnings so far?
Well, I think it's going to be a choppy second half. I mean, first of all, we have election uncertainty. A month ago we thought, a Trump victory, a layup. It ain't a layup. And there's a lot of uncertainty, coming into November, and then there's going to be earnings uncertainty. We heard some negative things on these calls. So, we had a huge gain at the beginning of the year, and I said, we should be happy with another 5-8% gain. And all of a sudden it went to 15, 20, and then, people think it's the new norm. I get, 10% every 6 months. We have to realize long term that's way above normal. So. Yeah. We shouldn't be surprised to have maybe a rocky period ahead, and maybe at the end of this period, some good values for 2025.
And that is a great point about sort of sentiment and sort of selling begetting more selling, whether you're looking at the systemic funds that sort of have to sell as the tide really turns, like CTAs or vol funds, and just general sentiment. Like, this is the day that my husband texts me and says, oh my gosh, what's happening to the economy? It's that kind of day. How long do those kind of days last?
Well, this just felt different than what we've seen, because really, here's a day where, before we thought cooling off a good thing, it would encourage the Fed to go down. So when we got some cool data in the past, we didn't have the effect on stocks. This was the first one where people looked at it. I've been looking at, jobless claims. They've been creeping up. Actually, if you make a correction for seasonality that brought them up last year, this, I think, is the highest that we've had since the pandemic. There's a lot of talk about the SOM rule, 0.5 percentage point rise in unemployment rate. So, I mean, this feels, now I'm not calling a recession, but this is the most real slowdown signals that we've had since the pandemic of 2020.
Okay, the most real signal of a slowdown we've had since the pandemic. Critical moment then here, Professor. I want to just mention as well the decline in bond yields that we're seeing. The 10-year yield falling below 4% yesterday. Today, it is down to 3.80%. If bond yields do keep falling, how much could that boost the stock market, given, again, what you've heard from companies so far in terms of what they anticipate their earnings to look like?
Well, this might be the final time of a good signal for those dividend-paying stocks. We know they've lagged dramatically over the last, several years. But now, if we're going to be looking at long-term interest rates 4, and who knows, it could go down to 3, then a 3-4% dividend from stocks looks pretty good. And so that might be the defensive play for the coming months, is to go to sound dividend-paying stocks with good coverage that could withstand an economic slowdown without lowering their dividend. Again, it's been a long time since those stocks have, matched the S&P, but they very well could outperform in the next 6 months.
All right, that is definitely something to watch for then if we continue to see the yields falling. Jeremy Siegal, Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania, thank you so much. He's just getting us started because the NASDAQ has entered a correction. It's sinking 10% from its peak. So we're going to continue the conversation with tech valuation expert Aswath Damodaran of NYU for his take on where we stand with the big tech stocks.
All right, plus a deeper look at the dismal earnings report out of Intel. Sell-side analyst Matt Bryson over at Wedbush will join us in today's top calls.
And one of the weakest payrolls prints since the pandemic, Julia Pollak joins us to discuss the job numbers fueling growth fears in today's market. All that and more coming up. This is The Close.
Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action.
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic.
This is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the U.S. to fall into recession.
I think the price for interest rates is wrong today. I mean, should they have moved? I don't know that they were set up to move. Given what they had told the market prior to this.
I do think that we are seeing some of that nervousness around the economy playing through right now, and that might make the first Fed rate cut less extreme.
I think the market now fully understands that the Fed may be late.
Those were some of the voices earlier on Bloomberg Television reacting to the jobs numbers. So let's get more from Julia Pollak, Ziprecuiter chief economist. Julia, I understand the disappointment. The market's clearly in reaction mode. How do you categorize, though, the actual numbers that you see on a daily basis?
So the issue here is not that 114,000 is a good number. It's that the context has changed. So why is that a bad number? It's a bad number because unemployment is rising rapidly. This is not the labor market coming into balance and settling at this new normal. It's a labor market where the slowdown is broadening and accelerating. And that is what people are nervous about today.
And it seems to have caught a lot of people by surprise as well. We noted how the job growth number, the payrolls number, missed the estimates of 73 out of 74 economists who took part in a Bloomberg survey. There's also a downward revision to the June number, excuse me. Julia, are economists getting it wrong, or is the data just not clean? There's a lot of guesswork involved in the BLS's model that just gets revised later.
So I think that many labor market indicators have actually been weakening and deteriorating for quite a long time. Online job postings are already well below the pre-pandemic level. Many of the indicators inside this report have also become worse than in 2019. The hires rate is all the way back to where it was in 2014. I think there have been many reasons to say, wait a second, on the inflation front, if we counted housing inflation the way almost every other country does, we would have declared victory long ago. The New York Fed's measure of underlying inflation, its multivariate core trend inflation, that's 2.06%. It's bang on target. The Fed told us months ago that they'd be happy to cut before we got to 2%. Well, we're already at 2%, and the labor market is deteriorating materially. So why wait?
Can you give me some more color as to where we are seeing from your surveys that you guys do the most deterioration and how that evolves maybe over the next 6 months, kind of your window into that?
Sure. So, over the last year, we've actually had different industries trading spots. We had information do very poorly in 2023, but actually it looked like it was creeping back in the first half of this year. Transportation and warehousing also lost jobs in 23, but was gaining jobs slowly, much more slowly than before the pandemic, definitely more slowly than in 2021 and 2022. But that sector looked like it was moving from rolling recession into rolling recovery. Now, even those sectors that were looking promising at the start of the year also looked kind of weak in this report. The number I've been focused on is the private sector payroll gains outside of healthcare. That number fell to 33,000. Its average over the last 3 months was 75,000. Before the pandemic, it was 137,000 each month on average between 2015 and 2019. So this is really a labor market where the core pieces, the core parts of the economy, the private sector outside of healthcare, has been weak and deteriorating rapidly.
Also, when you look at wages, noticeably the average hourly earnings and on a month-over-month, and on a year-over-year basis have slowed down and came in lighter than anticipated. What are you seeing in your surveys that matches or perhaps challenges that set of numbers?
So that's very consistent with what we're seeing. In our Job Seeker Confidence Index, we got the lowest readings since early 2022. In our new hires survey, we saw large decreases in the shares of workers who got signing bonuses, who got recruited, who got pay raises when they switched jobs. So clearly workers are losing bargaining power and leverage. It's not just the top level sort of payroll numbers that show deterioration. households, workers, they're feeling it, and it's knocking their confidence. We saw a big decline in the share of workers who negotiated their offers, and among those who did negotiate, we saw a decline in the share who were successful.
All right, Julia, really appreciate your giving us some context to those numbers. Julia Pollak is Ziprecuiter chief economist, and of course, on this jobs day, critical to put all the moves that we're seeing in context, including the fact that even though the S&P 500 is down by a lot, there's still 100 names that are gaining, and the ones that are gaining, notably, are all safe sectors. Consumer staples, for instance, you've got Clorox gaining ground, Mondelez, the cookie maker, up 3 1/3%. Kraft Heinz. Catch up anyone? 2.25% gain.
And they have the dividends, right? It's not huge dividend, but you get anywhere between solid 2 to 4% with some of those names. And there you go, as yields continue to come down. So some winners there, but it is a winner to safety. It is not a winner to something super cool.
Right. And these are the names that have been ignored for pretty much during the tech run up.
Yeah. What's not ignored is Intel having a terrible day. We're going to break that down coming up next. This is The Close on Bloomberg. All right, time now for top calls. A look at some of the big movers on the back of analyst recommendation. Let's start with Morgan Stanley, the Wall Street lender getting its sole sell rating from Wells Fargo after analyst Mike Mayo cut the stock to underweight from equal weight. Mayo saying Morgan Stanley has the highest forward price to earnings valuation of any large cap bank, despite negative trends like slowing wealth flows and pressure on net interest income. Those shares getting hurt by about 6%. And Crocs is next in line. You got Raymond James stepping away from its strong buy rating, cutting the footwear company to outperform. Price target is now set at $164. Analysts telling investors to err on the side of caution for what he felt was a conservative second half outlook from a strong performing brand. Shares are down 6%. And let's end things with Intel. You got a slew of downgrades and price target cuts for the chip maker after last night's second quarter report and outlook completely missed the mark. Bank of America, one of them, cutting Intel to underperform and warning investors that there's no quick or easy fix in sight to address profitability. Those shares falling the most on record. Scarlett?
All right, Intel stock, as we mentioned, posting its worst day on record. In addition to giving weak guidance for this quarter, Intel is also slashing 15,000 jobs and suspending its dividend, really underscoring how it's trying to conserve cash right now. The CFO, David Zinsser, saying, quote, "We're putting reduction in place in terms of operating expense, resizing the capital investment to reflect where we are in terms of revenue. I think we now have that into a much better place." So joining us now to tell us what Intel needs to do to get to that better place, Matt Bryson, Senior Vice President of Equity Research at Wedbush. He cut his price target to $25 from $30 to $50, and he has a neutral rating. Matt, first up, let me just understand correctly. I read a lot of notes, and they all use the word reset when it comes to Intel. What is being reset here when it comes to Intel today?
I think largely they're taking down expectations for 2024, 2025, and then also some of the expenses that they planned. So some of their fab build-outs, for instance, are being reset, if you will.
Intel also mentioned liquidity. When you have a tech company talking about liquidity that's not a startup, Matt, is that surprising?
I think that they also talked about being cash flow neutral once you take into account the investment they're getting from third parties and government subsidies. I think it's a little bit concerning that liquidity comes up. At the same time, I think what you're seeing in terms of a reaction today is less about liquidity concerns and more about Intel's been telling us that they have a 5, 6, 7 year plan, and to trust the plan, it becomes hard to trust the plan when they have a difficult time meeting expectations over the next 3, 6, 9 months.
Absolutely. So is this a management problem? Is this a Pat Gelsinger problem, Matt?
I don't think it's necessarily a Pat Gelsinger problem. I certainly think that they should have had a better handle on what exactly PC demand looked like, what exactly server demand looked like, where their share was going to be. They could have given the street better expectations. They certainly could have updated us intra-quarter. But in terms of what their strategy's got to be, if they're going to be a manufacturing company and they're going to compete with TSM, which is a perfectly legitimate strategy, then you've got to invest, and that's what they've been doing. It's simply catching up takes time.
So this is just, they're in an investment phase. They got to go through that. At the same time, any sort of hardware growth in terms of PCs that use AI, that hasn't really kicked in yet. When does that part kick in and wind up helping Intel?
Yeah, so, they told us that part of the problem is actually tied to the fact that they're seeing more demand for AI PCs than they thought, and they just hadn't set up their manufacturing properly to deal with that. So they're taking a hit this quarter, next quarter, because ramps cost more money. They take a hit next year because the platform that they designed for AI is mostly built by TSM, and that costs more. And so they clearly, 2 years ago, 3 years ago, when they were laying out these product sets, they could have made some different decisions that they didn't. But I think things are getting better. It's just a question of can Intel execute?
Yeah.
And if they do, is it the right strategy?
Very quickly, Matt, I just want to get your take on when or what would prompt you to actually cut this stock to the equivalent of a sell. What do you need to see?
Yeah, I mean, I think at this point that the problem is they have a ton of fab assets, right? So it's not so much that Intel is losing money or that their outlook's getting worse. It's at some point you value them on their assets.
Got it.
And when they get down to values like this, that they're trading below their asset values.
Okay. Matt, really appreciate it. Matt Bryson over at Wedbush. He's got a neutral rating on Intel. And of course, Intel not the only one. You look at the Philadelphia Semiconductor Index, off 5.5%. There's only one gainer out of 30. You can see some of the big losses there, whether it's Applied Materials, which is a chip equipment maker, or whether it's an actual chip company like NVIDIA.
Yeah, interesting, though. Amelius Research coming out and saying that, look, Intel's woes is great news for AMD. So one woes in Intel is going to be upside for others. But let's stay in tech, because obviously big tech selling off hard today. We're going to hear from Aswath Damodaran, professor of finance at the Leonard School of Business. He is the valuation expert. If AI wasn't a bubble, has it now burst? And where do we go when the NASDAQ has now hit its correction territory? We're going to break that down. Looking at S&P here, off by over 2%. This is Bloomberg. We are about 30 minutes away from the closing bell. It is a brutal day out there. Yes, we're off the lows, but particularly in tech, still getting hit. You have Amazon, Intel, NVIDIA. You have Microsoft, all getting hit pretty hard. You have the NASDAQ 100 off by over 2% now, 443 points, and a big chunk of that is Intel.
And it's down 10% from its peak, so it's entered a correction. And what's notable of those four names that you mentioned, one still hasn't even reported earnings yet. That's coming up at the end of this month.
Oh my God, that's right, NVIDIA. Yeah, which is interesting, because Cameron Price wrote a piece today. Did you see that? That was like, basically the market is going to be Princess Leia. Like, help me, Obi-Wan, you're my only hope. In that, who's going to come in and help the market? Is it going to be Powell, or is it actually going to be NVIDIA?
So NVIDIA looks like Princess Leia right now with the
with the buns?
Yeah.
Yes, exactly. Okay. All right, well, anyway, in a note that's seen by the Financial Times, this is a note to investors by the Financial Times. Elliott Management calls AI overhyped and says its supposed users are never going to be cost efficient and never going to actually work right. It will take up too much energy or will prove to be untrustworthy. Now, Elliott declined to comment to the FT. Joining us now with his insights is Aswath Damodaran, professor of finance at the Leonard School of Business, also the expert on valuation. So if AI is overhyped, has that AI bubble now burst, Aswath?
I think this is a bubble that's going to burst, build up again, burst again. I mean, it is a revolutionary change. I think Elliott's going a little bit over the line in terms of talking about it not having an effect. But like all revolutionary changes, it's going to have a few winners, lots of losers. The net effect is going to be surprisingly small. It's not like companies are going to become more profitable because they've replaced people with AI. And if everybody has it, nobody has it. If you cut costs and you can't pass them through, essentially you're stuck with the same or lower margins than you were historically. So I've always been a little skeptical about AI being the the change that will make markets more valuable. And I think we're coming to that recognition a little slowly. But the Microsoft and NVIDIA price action today is a coming back to earth of those AI dreams.
That's really interesting what you said about how if everyone has AI, no one can really profit off of it. And perhaps we're starting to get some recognition of that. At what point, what would it take for the broader market to start to really absorb that and accept that?
I think reality takes multiple steps. When you're talking about something that can take the next decade to unfold, I think the first effects are going to show up in the companies that are actually making money on AI. The NVIDIAs that provide the architecture for AI, and the big tech companies which have the cloud, they essentially use the cloud to make money on AI. You're going to see numbers come in that are below what people thought they could deliver. The next phase is going to be these AI companies that go public with the biggest dreams, and many of them are never able to monetize those dreams. So like every other change, it takes a little while to play out, but you're going to see it play out maybe over a year, 2 years. It's not going to be overnight.
So, Aswath, how do we then value those kind of companies?
I think we have to step back and remember the laws of economics don't get suspended because you're talking about a great buzzword. There's demand and supply. AI, if it's going to be in the form of products, somebody's going to pay for those products, and it's a cost to those companies. So when people talk about AI being a $3 trillion or $4 trillion market, the question is who's paying? Where is that money coming from? And how can we afford that money if we can't pass it through as higher prices? So I think there's a lot of hype here. And I think you got to step back and say, what can really be accomplished with AI? And what are the companies that are best positioned to make money on AI?
I'm looking at the NASDAQ 100 and how much it's fallen for this week. And what's notable here is that this is the biggest 1 week drop. Let's see if we can pull this up. You know what? I'm having trouble pulling this up at the moment. But it is the biggest 1 week drop since July 19th, 2024. So maybe I'm not doing that right. But let me go back to
No, but I think you are. But I think that's the point. Because it's after CPI and we had that rotation.
Yes,
but that's the point. Like, we've seen this movie before. We've
seen this movie before, Aswath. And I guess what I want to come to you is you had said that it's not going to be overnight. How do you reconcile that with the violent moves that we've seen, not just this week, but in the last 2 weeks then for the NASDAQ 100? Is this move reflective of people accepting something, or is there actual panic taking place?
No, I think in a sense we've ridden the big tech companies for much of this market. And I think they've taken on a role that I think you cannot keep delivering on. So I think part of the reason the rotation is so violent is because we've become so dependent on these top 10, 15, 20 companies. Most of them are tech, for our market to be healthy. And that's not a good place for a market to be. It's always true that the biggest winners carry a market, but it's never been true that the biggest winners keep repeating year after year, which is what we've had for the last few years. So I think that's part of it, is that correction of something that cannot be sustained.
So how much more do you think this route has to go in tech?
I think that, you're going to probably see it, and it's not going to be across all tech. I think that if NVIDIA comes in with good earnings, they might be able to sustain themselves. But I think when momentum shifts, it's often decisive. And what was good news 3 months ago will become bad news. It's amazing. The same news story can become bad news, and the momentum has shifted, at least for the moment.
That's a really good point. You mentioned NVIDIA and it reporting decent earnings. What's interesting about that Elliott letter was that Elliott had said that on what may trigger an actual market bubble bursting is if NVIDIA reports poor numbers and breaks the spell. Do you see enough skepticism on a company like NVIDIA?
I don't think so. I think that people are, at least for the last year and a half, have been giving NVIDIA every benefit of the doubt. And they remind me of a friend of mine who was a Dodger fan. At the start of the season, he expected the Dodgers to win 125 games this season. And I said, look, that's the most games that any baseball team has ever won in a season. If that's what you're expecting, all you're going to get are negative surprises. In many ways, NVIDIA's pricing reflects that. People are expecting things that no company in history has ever been able to deliver. No company. And I think that's a lot to ask for a company. And the only thing you can get is negative surprises when you do that.
That again, a really good point. Just sort of the confirmation bias and the contrary bias on that point. Before we let you go, Aswath, as we're sort of re-rating here, do you think that money goes elsewhere, or does it go on the sidelines? When the sentiment shifts, what can it pull into its vortex?
It disappears. That's the problem with markets, right? It's not as if people cashed out $2.9 trillion today. It just disappeared into thin air. That's a scary thing about markets is the value can disappear into thin air. It's not like people have cash in their pockets because by the time they cash out, they've already lost value. So in a sense, it's money draining out of the system that's gone. And I think that's the plus and minus of markets. Markets can create trillions out of nothing and they can take trillions away.
Aswath, that was a great ending. We appreciate you very much. Thanks for coming on. Aswath Damodaran, finance professor at the Leonard Stern School of Business, which funnily enough, then, Scarlett, that's going to feed into tighter U.S. financial conditions, which has the adverse effect of what the Fed may want to see. And then that narrative of like, oh, all those people who were sitting in treasuries at 5% and made all that money in the stock market, that's not there anymore.
So we go back to blaming the Fed for not moving quickly enough, for not seeing around the corner, for not knowing that this was coming.
Yeah. And also, funnily enough, so Scarlett went down the rabbit hole, did you not, about NVIDIA and the sell earnings, which to the point of like, if you expect awesomeness, but we've never seen this awesomeness before, how do you actually judge it?
Yeah, I was looking to see if any analyst had cut their estimates for NVIDIA EPS for later this year or for the full year. I found 2 analysts for the full year. They're both in Asia, so we can't get a hold of them right now. It's 3 a.m. there, but we will.
We will. We definitely will, because we want to get that into earnings. Well, NVIDIA save the market, or does it have to be Powell? All right, coming up, we're going to talk about shares of Chevron. They are in the red. The company calls it quits on California headquarters. I spoke to the CEO and Chairman Mike Wirth earlier in the day. That's coming up, stock of the hour. We're coming up next. We're about 20 minutes away from the closing bell. The S&P off 2%. This is Bloomberg.
Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, premieres August 9th, only on Bloomberg.
Time now for today's stock of the hour. I'm watching shares of Chevron. They're down by about 2.4%. Yes, it's a tough tape, but they were down yesterday as well. They reported a profit miss early in the morning. They also announced a surprise plan to move their California headquarters to Texas. Plus, the arbitration with Exxon to acquire Hess has now been pushed back to May of 2025, robbing Chevron the chance to get involved in Guyana, a prolific area off the coast of South America. I sat down with CEO Mike Wirth, and he shared his outlook on the global oil market, which has been very weak of late.
It's a market that I think has the prospect of being very well supplied. It's pretty balanced right now. Obviously, there are geopolitical tensions in different parts of the world that can put supply at risk. So it's a little tough for the market to weigh all of that. But at a fundamental level, I think the supply side is strong enough that people are keeping a close eye on that.
Which is really interesting, Scarlett, because oil in itself has been down like 11% in just the last month alone. So that's clearly the theory was that what's up with China?
Yeah.
Is it a weak demand story, et cetera? But it was interesting to hear from Mike that he really thinks it's a supply issue.
And you look at oil today, and it's down again, I think the lowest in almost 7 months on that twin concern, not just China, but now you have U.S. added to it as well, given the weak jobs number.
Yeah, that growth scare, which good jobs number. So we were talking as the jobs number came out, and I said, hey, look, this jobs number is really terrible, Mike. Like from where you sit as an oil CEO, do you see weakness in the U.S. economy? And here's part of what he had to say.
The U.S. economy to us still feels like it's moving along, and the prospects of a recession, which a year and a half ago people were very concerned about, have diminished. We'll certainly still see a business cycle. There's no doubt, but we don't see any warning signs that are alarming in U.S. economic data right now.
I thought that was kind of interesting because he didn't see it. He didn't see that kind of weakness.
And even with all the hand-wringing over today's jobs number, no one's talking about recession just yet. They're just talking about how quickly the conditions have changed in the labor market from what we had before to what we have now. And perhaps maybe not entirely trusting what the BLS is telling us month in and month out.
Yeah, and it also goes to just in terms of what we're seeing in the actual market, too. Like, a correction was kind of expected at some point, right? Ira Jersey's been talking about a rally in the front end of the bond market for quite a long time. Just no one expected it to happen in one day.
Yeah.
So going to where we are with the 2-year might not be crazy, but maybe in one day it's a question mark.
This unwinding of all these risky trades of the big AI trade, Aswath Damodaran of NYU Stern School of Business was just saying that it's kind of painful that it's happening so quickly, but maybe it's less painful that it happens this quickly as opposed to being drawn out. Yeah, over time.
Funnily enough, we go back to commodities, drip feed, crude down by about 3%. Yeah. Crude has been getting hit consistently, and that is really a China part story, which is then funny because copper is trading flat. So it's not trading necessarily on those growth concerns. Yeah, which I think is also quite interesting as well.
Gold is also not getting the boost you might expect on a day in which there's a flight to safety. Gold currently down 0.4%. I would have thought it would have gotten a little bit of a lift the way treasuries have gotten a lift.
No, because you get a cut, and then you kind of sell gold when you need it, when other assets are getting hit hard. Anyway, we're going to continue to count you down to those closing bells. Adam Turnquist, Chief Technical Strategist over at LPL Financial, will be joining us. A lot of technical damage could have been done today. We're going to dig through what's left. This is The Close on Bloomberg.
The honeymoon is over. Let's put it that way. Jay Powell and Fed enjoyed this idea that, we can bring inflation down, no real consequences. We can wait and wait and wait. Well, I think he waited too long.
That was the one and only Jeremy Siegal, Professor Emeritus of Finance at the Wharton School, kicking off the show. And notable when you have a perennial optimist like Jeremy Siegal saying the honeymoon is over based on what we're seeing today and the results that we've been getting.
He said the most real slowdown signal that we've seen since 2020.
Yeah, based on the jobs number. And, Jay Powell is probably maybe feeling a little bit of regret that he didn't get all this before the FOMC decision.
Non-buyer's remorse, and you can see it across the board in the equity market, running for cover, right? Sell equities across the board. Sell the NASDAQ 100. Intel having a terrible day. That is idiosyncratic to Intel, but you can see it bleeding into all the other areas of the market. And the Russell 2000 underperforming. Yeah. And the question, to me, the question is so that rotation's done? Do you buy the dip in the Russell? Do we still like that if the Fed's going to have to cut 100 basis points this year or not?
It's definitely on pause for now, and we'll sift through and see what happens. But you mentioned Intel being idiosyncratic, but most companies are not totally prepared for this AI age. I mean, Intel's a lot farther behind because it's in the exact industry that NVIDIA and AMD are in, but there are a lot of companies are scrambling to play catch up, and they might not be able to get there.
That's really good point.
And even as they spend more and more.
And that re-rating going to be very severe, apparently, when you have to.
Yeah. So if you look at what's going on in the markets right now in terms of what's actually rising, the ones that are gaining ground is notable, right? You've got a bunch of consumer staples names. They kind of hold on to their customers no matter what. All right, so let's broaden this conversation now and bring in Adam Turnquist. He is Chief Technical Strategist over at LPL Financial, the perfect guy to speak with on a day like today when you've got big declines in equity markets. Adam, first off, do you see anything disorderly today or this week?
I'm going to go with Jeremy Siegal's "the honeymoon is over" line. I'm going to steal that from him and talk about that in volatility, because I think the period of volatility of that low vol regime we witnessed in the first half may be over as we go into the second half. And you can see that playing out as we roll into August, historically a weak month, followed by a weaker month in September. But in terms of major disruptions, I think you have to frame it up in two ways. On the shorter term, we're seeing a lot of technical damage in the market. But longer term, and I think this is important for investors, the bull market is still alive. We're still trending higher above a 200-day moving average. And some of the breadth metrics that we look at, including how many stocks are above their 200-day moving average, that's holding up well, but that doesn't mean we're not subjective to some further downside here for the S&P 500.
So I made a very dramatic statement, sort of, the technical nightmare that we've seen unfold today. Was there a technical nightmare? Have we hit some severe levels where selling begets selling and then it just becomes a self-fulfilling prophecy here?
In the tech sector and the semiconductor space, I would call it some pretty important levels were violated. We're taking out the March highs. I think both of those, the sector and the sub-industry group, could be subject to downside closer to their 200-day moving average, even the April lows. And you have to ask yourself, if semiconductors and the tech sector have further downside to go, how's the rest of the market not going to follow, especially considering semiconductors have been a consistent leader of the bull market, lead on the way up, lead on the way down. So I do think we could see some further downside. On the S&P, though, keep an eye on the March highs right around 53.21 if we start breaking that level. I think maybe worst case, we get down to those April lows and 200-day moving average call it 49.50 to 5,000 for those levels.
What about small caps, Adam? I'm looking at the Russell 2000, and it's holding right above its 50-day moving average. It's got a little ways to go before it hits that 100-day moving average. But in terms of where it is versus where it was before that very cool June CPI report, it's only up about 2.7%. Technically, how distressed or how fragile does the Russell 2000 look?
Right now, with small caps, this is probably the number one question I'm getting. Is this rally real? Of course, we had a significant pullback as we witnessed the labor market cool off here, especially some further evidence of that today. And small caps right now, when you look at it, it's on a relative game versus large cap, and they're still underperforming. That's the longer term trend. There's still some resistance to go through to get to new highs on either the S&P 600 or the Russell 2000. Very broad-based rally coming out of their range that they've been stuck in for most of the year. But I think there's more work to do there, not just on an absolute basis, but on a relative basis, because that longer-term downtrend of underperformance is still in play.
So to that point, if I just look at a chart with its moving averages, we had a really big gap up after we got that CPI report in mid-July. Is this downturn, though, for the small caps just filling that gap? And if we hold the moving averages of 50 and the 100-day, are we going to be okay here? Or if we break that, what happens?
I think that could be the case where we're just filling the gap. I think it's going to really depend on the data coming out. Small caps much more economically sensitive, and that recession risk, if that does continue to rise, it's not going to look good for small caps on an absolute or relative basis. So I think the play here for investors is lean a little bit more toward large over small until we get some clarity on where the labor market is really going.
I got to ask you about seasonality because a lot of times nothing much happens in August. September tends to, be when people come back into the market again. But we've got an election year as well to consider. So how are you thinking about what we should pay attention to based on historical patterns, given what is going to take place this November?
Volatility tends to ramp up as we get closer to Election Day, whether that's the VIX, if you look at the implied volatility, tends to peak right around Election Day. And the one big stat that we're watching closely, especially it starts on Monday, we're going to be 3 months from Election Day. How the market performs in that 3-month window has been a really good indicator for the election outcome, meaning if the market, the S&P 500 that is higher during that 3-month window, the incumbent president or party tends to win the White House, and vice versa. The market's lower, it tends to get a flip in the White House. That's happened at 20 of the last 24 elections.
All right, great to keep in mind. Adam, really appreciate your joining us today. Adam Turnquist is Chief Technical Strategist over at LPL Financial. I think the quote of the day right now, based on what Jeremy Siegal was saying, what Adam Turnquist just told us, is the honeymoon is over.
Yeah, honeymoon is over, and it's definitely over for certain areas of tech as well. Just take a look at some of the losers here. We're about 4 minutes away from the closing bell. You have Intel holding firm down about 26%. This is within the NASDAQ, losers within the NASDAQ 100. Also, Amazon off after earnings yesterday, which we haven't even talked about, down by 8%. You also have Micron is down with the chip sector like Intel, and you Applied Materials also. All that really weighing on the NASDAQ 100.
But you mentioned earnings. Apple reported earnings, and it's kind of been forgotten in all this. Yes, because it came out with numbers, and the focus really is on what Tim Cook is going to say about the refresh cycle for the iPhone 16. Right now, still holding on to a gain. It's pared some of its advance, but still holding on to a gain. DoorDash, a big gainer too, up more than 8%.
That's such a good point. And then on the flip side, you have like Clorox, you have Mondelez also doing well. That's going to be like a safety play. But the fact that Apple's holding its own when the NASDAQ 100 is getting really pummeled, I also think is quite interesting, and particularly when you're seeing a lot of volatility pick up.
It didn't benefit as much from the whole AI play heading up into its results as much as the other companies did, right? Because it's still all based on a refresh cycle.
Yeah.
We're moving closer to the closing bell. We've got full market coverage right here on Bloomberg Television and Bloomberg Radio. Keep it right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Alex Steele here to take you through the closing bell. It's a global simulcast, which means that we have now brought in Carol Massar and Tim Stanovic to help make sense and really show you the numbers here and show you the context of what's going on in the equity markets. Welcome to our Bloomberg Television, radio, and YouTube audiences worldwide. Carol Massar, I think we all knew when the opening bell was about to ring that this was going to be a brutal day given the jobs report we got.
Interesting day, but you know what I find fascinating is that we're not seeing, at least right at this moment, some selling into the close, that we are off our worst levels of the session. Yes, a technical correction, 10% on the NASDAQ 100 from that July peak. But having said that, I don't know. I feel like we've had a lot of guests who said, let's take a breather. It's one report. We know there's a trend. We're concerned about a weakness, but not the world isn't falling apart.
Yeah, that's exactly what Torsten Slok told us from Apollo. He joined us at the top of our hour. And he said, look, I changed my view after we heard from the Fed yesterday, and I changed my view after seeing the data today. We do think the Fed will cut in September, but he said this is just one data point, and he still pointed to a lot of alternative data that showed that what he believes is a very strong U.S. consumer and a very strong economy.
Well, what's come up in the last hour for us is that the narrative has changed.
Mm-hmm.
Like the story has changed. You can parse through the data in a different way, but overall, that's kind of what we're dealing with. And you can definitely see that if you just look at the VIX, not only the jump, but the VIX curve and how quickly we've re-rated. Even the volatility of the VIX has been impacted significantly, and holding that volatility regime higher would also be another shift for the markets. All right, those are your closing bells. Whew, we made it there. Volume quite elevated. We're still settling out here, but it looks like we got the Dow Jones Industrial Average off by 1.5%, S&P off by a little less than 2%, the Nasdaq off by 2.4%. And as Carol, you were saying, it could have been worse just even a few hours ago.
Yeah, absolutely. All right, folks, so staying with the big cap names here, the S&P 500, 372 names to the downside, 131 gaining ground. But I just want to point out, guys, you want to guess what the worst performing name in the S&P 500 is this week?
Not Intel?
It is Intel.
Oh, okay.
Over to you, Scarlett.
Hey, Scarlett, good guess.
Well done.
I pass. Okay, let's take a look at how the sector performances shape up. You see a lot of red there, and that is mainly because of weakness across 8 of the 11 sectors. Consumer discretionary losing 4.5%. Financials down 2.4%. Energy losing 2.25%. Tech, by the way, is only off by 2%. I mean, there's 4 sectors that have fallen more than tech. What's notable, of course, is those that have bucked the decline. You've got consumer staples, utility, and REITs. Definitely a play for defensive sectors, for sectors that pay out consistent dividends and that are supposed to do well in tough times.
All right, guys, let's get to some of the individual gainers. And we talk about, sometimes market rotation. We'll get to that, and I'll show you why I say that. First of all, though, Apple did eke out a gain at its highs, up 3.3% in the trade, finishing the day with a gain of about 0.7%. So it was one of the top gainers throughout the day on the NASDAQ 100. Analysts optimistic about the company's iPhone 16 launch and AI rollout plans. Apple did predict that its new AI features will spur iPhone upgrades in coming months, helping the company reemerge from a sales slowdown that has hit as China businesses, especially hard. So upbeat third quarter results, mostly we know, we broke it down last night, but those sluggish sales in China. So here's what I talk about market rotation a little bit. Clorox is your number one gainer in the S&P 500 today. Shares jumping up 7.5% here at the close. Company reported fiscal fourth quarter adjusted EPS that topped the average analyst estimate, issued a better than expected profit outlook for the year. And on to DoorDash we go. This one finishing just off its highs, up more than 8% today. Number 2 gainer in the NASDAQ 100. The company's third quarter adjusted EBITDA forecast coming ahead of consensus estimates. It also showed delivery order growth, so few gainers in that Friday trade.
Yeah, just a few. There were a lot of decliners, though, that I could choose from. And in fact, every single decliner on my list today fell at least double digits. I got to start with Intel. It's down 57% so far this year, guys, after today's drop of 26%. It's the biggest single-day drop. It's going all the way back to the early 1980s when Bloomberg started keeping track, perhaps going all the way back to its IPO. Right now, trading at levels last seen since 2015. It shed more than a quarter of its value today. The company gave that grim forecast. It laid out plans to slash 15,000 jobs. It signaled that they're ill-equipped to compete in the artificial intelligence era, also suspending dividend payments to shareholders starting in the fourth quarter. And it's going to continue that until, quote, cash flows improve to sustainably higher levels. The company has paid a dividend going back to 1992. Shares of Amazon falling by 8.8%. Closing by 8.8%. At one point, it was down 10%. Shares falling the most in more than 2 years. Shares fell after the company told investors that profits for now will take a backseat to heavy spending on AI. Amazon said that operating income for the current quarter that ends next month will be $11.5 billion to $15 billion. Analysts were looking for $15.7 billion. And then check out what shares of Snap did today. They fell 27%, which for a lot of other companies, that would be a superlative going back the most since, in many years or the most ever. Well, it's just the worst day for Snap since going back to February when it fell 35% in a single day. So it just shows the volatility and the big one-day moves that this company makes. The company did report disappointing second quarter sales. It gave a lower than expected outlook for earnings in the current period. Actually did see stronger user growth, marking a step back in the company's years-long quest to rebuild its core advertising business. But still, second quarter sales and lower than expected outlook disappointed investors. Shares of Snap finishing the day down by 27%, down 45% so far this year.
Yeah, it's also because Meta did well on ads, so I wonder if there was also a tough comp on that one. All right, guys, bond market super active today. Buying across the curve, but the buying in the front end was very dramatic. You're looking at 2-year yields on the day down 26 basis points, but on the week, the 2-year yield is down 50 basis points. That's the kind of move that we saw back in March of 2023 when the SVB crisis bubbled up into view. And just to point this out, the 210 curve steepened the most since 2022. I mean, these are really deep superlatives in a bond market that has been very whippy and moved a lot very, very fast.
All right, so you might, as an investor, think you've had a rough week. But if you are an investor who also rides New Jersey Transit, you've really had a rough week. I don't know if you guys saw this story. It's among the most read. It just starts with this. One passenger suffered repeated panic attacks. Another held hands to try and comfort each other. Firefighters attended to at least 2 people with medical issues. Business workers shed layer after layer of clothes drenched in sweat because a New Jersey Transit train last night got stuck underground and then the air conditioning didn't work.
Wednesday evening.
Yeah.
Oh my God.
Sorry, Wednesday evening.
By the way, the context here is there's a bit of a heat wave in the Northeast. I mean, the humidity is out of control. Every day it's like 89, 90 degrees,
like
but it feels like 95 degrees.
Yeah.
This is the stuff of true nightmares. Like, this is the stuff that, you never want to have happen to you and that you get. Maybe it's just me, guys. I don't know.
No. This
I
is
do not want to be stuck
you can get heat stroke and stuff.
under
like,
a body of water in a train with no power, no air conditioning, and no idea when this thing is going to start moving. Apparently, only Verizon service worked on the phone, so passengers were giving each other their phones so they could make calls and make adjustments. They ultimately got towed back to Penn Station. Some people
where they started from, by the way.
They had to get a diesel engine from Amtrak to tow them back to Penn Station.
Did they get Krispy Kreme cards or something?
I don't know.
Yeah,
infrastructure. Can you imagine getting back on a train after that?
You can't blame anyone for wanting to leave the tri-state area and going maybe down south to Florida, right? The problem there, though, is that you have impossible traffic because so many people have the same idea. They're all moving to Florida, and now you're stuck in gridlock all the time. The cities in Florida don't necessarily have the infrastructure to deal with this influx of people who have come in and have stayed since the pandemic.
Wait, so that's seriously a thing? So now we're looking at crazy kind of traffic, but now in Miami because all the New Yorkers left and went there?
It's costing commuters an average of 70 hours each year, and that adds up to, according to one estimate, $3.1 billion in losses.
Oh, what are you going to throw out there?
Public transit, infrastructure?
That's a big problem,
investment there? Would that sort of alleviate some of the pain that we're talking about?
But do they have public transit in the same way that we're used to? No, right?
What I'm saying is it could
have
alleviate
driver's
some of that
license,
pain.
right?
Yeah.
8 out of 10 have driver's license. So there is no mass transportation.
How do you do that? Do you raise taxes in order to pay for that?
No, you can't do that. It's Florida, right?
Well, then what do you do?
You got to hit the road.
Oh, wait.
That's what you do.
Ken Griffin, you came down. Maybe you can help us solve this problem?
Maybe it's a private. Maybe it's a private thing.
There are private solutions, but they cost. Yeah, they cost money.
Got to call Elon to build the boring company tunnel there, right?
I love those tunnels. Yeah. I think it's a great idea.
Yeah, if it's actually implemented.
All right, you guys, stay cool. Hopefully it's going to ease a little bit.
Maybe I hope you don't take New Jersey Transit
I was like,
home,
good luck
by the
getting
way.
home, Carol.
I'm getting into a tunnel very soon, guys. All right, have a great weekend, you guys. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, folks. We will see you again, same time. Some of us, I think Tim's going on vacation.
That's okay. I'll see you guys soon.
Yeah, but we'll see you guys on Monday.
Safe travels, Tim.
Thank you.
All right, coming up on the close, Citi is now forecasting 2 supersized Fed cuts this year. We're going to speak to the economist behind that call, Veronica Clark, up next. This is the close on Bloomberg. Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. It was a week for the record books. Let's take a look at where markets closed out here. Running for cover. Honeymoon is over. Take your superlative and run with it. Jeremy Siegal like the honeymoon is over. So the S&P 500 ended today down just 1.8%. I say just because it was a lot worse earlier, down by about 2.8%. And that would have been the worst slide since 2022. So we did see a little bit of volume come in at the end of the close. We did see off the lows of the session. The VIX, though, having a big jump in a very short amount of time. You look at the VIX curve from just a week ago, a huge re-rating now has taken place within volatility, which you can be sure has then affected those systemic funds that track volatility and have to follow the trend, like CTAs or vol funds. That's going to exacerbate any kind of selling that we see. The money is very clear where it's going. The money is going into the bond market, particularly the front end, and into the yen. 146. Remember when it was 160? We were talking about that intervention. Nope, 146 for a dollar yen is the yen, as well as the bond market shine for some safety trade, Scar.
Yeah, so some big moves on the macro front, some big moves on the micro front, particularly with Intel losing 26% on the day, the biggest drop ever, at least in data that we track going back about 40 years. Clearly the worst performer in the S&P 500 as well. It gave soft guidance for this current quarter and also indicated it is going to cut 15,000 jobs and suspend its dividend. The CFO talked about liquidity in the press release, which definitely raised some eyebrows. Amazon.com coming out with results as well. Again, AI spending unnerving investors. This is a theme that we've seen across the Mag 7 names. It was the case for Amazon as well. That stock having its biggest drop since April of 2022. And I did want to end on a company that did better. Apple also came out with earnings up 0.7%. Tim Cook talking about the AI features, the Apple Intelligence features will spur phone upgrades when the iPhone 16 comes out and the iOS is ready for it. That'll be in the coming year. It's not going to start right away when the iPhone launches in September. But we got to go back to the broad market overall because our top story this hour is really about the losses that we've seen. At its low, the stock market was holding its best, or I should say its worst jobs day in 2 years, its biggest decline on a jobs day in 2 years. And that pushed the NASDAQ, seen here, into a correction, down 10% from its peak. While bonds, they rallied hard, pushing yields lower. Bad economic data is no longer good news for risky assets. Traders are now pricing in a full percentage point of rate cuts this year, and debate is really generating on whether we are on course for recession.
All right, well, let's bring in Jess Menton. She covers Bloomberg Equities for us. She also deputy team leader and been digging through this throughout the whole day. Jess, what is my narrative from this week?
Right, so a lot of people are pointing to economic data, growth concerns, but when I'm speaking with my sources, so whether it's portfolio managers, people who are working at hedge funds, maybe even just swing traders, a lot of this is more the rotational trade is still on. It's just the rotation's going to other pockets of the market. So, Alex, you and I were co-hosting on radio earlier today. So you and I were talking about how a lot of times my sources, of course, the big run we saw, say, in the Russell 2000 in July, huge historical outperformance if you're looking at it against when it comes to large caps. But the argument for that at the time towards, say, mid-June, late June, going into that rotational trade was that they're just so cheap. But now if you look at where after that run did, they weren't as cheap as they had been. And then the question was, well, what about its earnings outlook? And that still is a question mark and remains really elusive there. So you've continued to see, actually, since Powell spoke on Wednesday, where a lot of this rotational money is going more toward those dividend kind of low volatility type sectors. So especially if you're looking at the flows. So Athanasios Theraphigas, I got him to pull some of the latest flows data from Bloomberg Intelligence for this week. So you saw some gangbuster numbers here for when it comes to real estate as well as utility flows there. So close to about $1 billion combined. If you look at technology, about 300 million. And then some of the ones you saw the biggest outflows were probably not surprisingly discretionary. Obviously the worst performing sector that we saw this week. Obviously Amazon was the big, because of its weighting today, pulling it down there. But you're seeing the rotation still going. It's just more toward those income driven type sectors that obviously the their weighting is a much smaller in the major indexes, say the S&P 500, than obviously technology and growth stocks.
And as much as we go on about how much weakness there is right now after that June CPI report, which kind of turned things around for the growthy tech stocks, it's worth noting that the NASDAQ Composite is still up 12% so far this year. I mean, it's gained a huge amount, and even with this pullback, it's still up by double-digit percentages.
And the S&P 500 from that October low is still up roughly about 30%. And Michael Hartnett over at Bank of America today, he puts out, they do their modeling on EPFR data flows, but he had an interesting stat talking about if you went back to the 70s and looked at how usually the S&P 500 performs leading up to, like 9 months leading up to a rate cut in that anticipation. Usually you would see the S&P 500 gain on average about 2%, but this time the S&P 500 was up double digits, around 30%. So obviously there's been a lot of exuberance. So a lot of traders I was speaking with, even heading into Wednesday before Powell, they were expecting to be kind of a sell the news type moment. Obviously Wednesday heading to the close, a tremendous rally, but we've seen that unwind. So a lot of them are kind of looking past not just the manufacturing data yesterday and obviously the jobs data today, but they still feel like there was a bit of a sell the news type moment there.
Sunday night when the futures open.
That's right.
Are they going to open higher?
So let's look at the technicals, right? So if you look at the RSI and it's looking at basically what oversold conditions look like, and the S&P 500 as well as the NASDAQ 100, they're both below 40 right now. Usually 30 is kind of the line in the sand. So a lot of technicians I've spoken with, they expect to see a bounce back just because of how bad the last 2 days were. But the thing is, the 200-day moving average for the S&P 500 is around 5,000, and then it's 100 days around 5,300. So they're thinking maybe a short-term bounce, but because we're in August and September, typically there's more low volume but higher volatility. We might see a rebound that could be short-lived, and then you might see a pullback down to where the 100-day moving averages or the 200-day.
Jess Menton, that's a lot for us to sift through and a lot for people to watch for when trading resumes next week. Thank you so much. Jess Menton covering cross assets for us here at Bloomberg. Coming up, we've seen some big Wall Street firms restate what they think is going to happen when it comes to interest rate cuts. They're now looking for more cuts this year, bigger cuts and earlier cuts, including Veronica Clark over at Citi. We're going to talk to her next. This is Bloomberg.
I think that I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
That was Chicago Fed President Austin Goolsbee speaking exclusively with Bloomberg's Mike McKee after today's payrolls report. Well, that prompted a flood of changes all across Wall Street banks on the Fed call. It all started to trickle in at around 10, 11 o'clock in the morning when those calls went out. And one of the first was over at Citi. So Veronica Clark and the team now revising their Fed forecast, saying we now expect the Fed to start the cutting cycle with 50 basis point cuts in September and November, followed by 25 basis point cuts at each subsequent meeting until reaching a policy rate of 3 to 3.25% by mid-2025. Veronica joins us now. Veronica, why a 50 basis point cut? Like, I feel like, okay, the data was weak, but we're not in negative jobs data.
Yeah, we're not in negative jobs data, at least in terms of headline payrolls, but we finally did see some slowing, and we've had this dynamic for a number of months now where payroll job growth have been consistently strong, but they've looked consistently out of line with every other labor market data point that we have, maybe most importantly, the unemployment rate. So even before today, we had seen the unemployment rate increasing really over the last year from a low last April. But that increase had accelerated in the last couple months, and it really accelerated today. So I think that is probably the better signal of really the loosening that's happening in the labor market, which now is honestly on the verge of an outright weakening in the labor market. And we know that the Fed is going to just be increasingly focused on the employment side of their mandate as inflation comes down, employment, as unemployment is rising. We do think they'll be pretty reactive to that and maybe even feel a little bit behind the curve by the time we get to that September meeting. So why not start with a bigger one?
So, Veronica, you would think that that's the case, but we spoke with Austin Goolsbee earlier, and he didn't necessarily sound like he was too worried. I mean, he made it clear that it's the Fed's job to figure out the through line of the data and move in a steady way. He didn't want to put too much stress on any one data point. What is someone like Austin Goolsbee getting wrong in cautioning we need to see more data confirm everything?
Yeah, I think that's probably the message that we'll hear from Fed officials right now. But it is still really important, to not read too much into 1 month of data. But this has now been many months of data where the unemployment rate has been increasing. And typically what we see in historical cycles is that the unemployment rate will very slowly start to rise until it does reach a point where it starts to rise much faster. This is really exemplified by that so-called SOM rule, which usually corresponds with recessions. We're very close to triggering that today, essentially trigger that today. So where we see the unemployment rate going for the next jobs report, that's really what we're forming our forecast on. So yeah, Fed officials will be a bit cautious to not conclude that we're going to be getting 50 basis point cuts. But based on where we see the data going, I think that's where we're headed.
Michael Feroli outdubbed you moments after you put out your note, saying that he could even make the case to preempt the September meeting and cut. Ooh. What do you think?
Never say never, of course. If we really are in a more sharply weakening, economic backdrop, weakening labor market, there always can be surprises. Maybe even, something if we get a large correction in equity markets, something like that. But there will be, one more employment report, and it really is these monthly employment reports, I think, that will matter most for the Fed. That will come out a couple weeks before the September meeting. It seems reasonable to just wait until that meeting at that point. But yeah, never say never.
Never say never. I saw a note from Neil Dutta of Renmac Economics, and he was saying how it's much better to ease when you can than to ease when you must. But it sounds like the Fed, based on the fact that they were late to the party, they were behind the curve when it came time to raise interest rates to begin with, are similarly cautious in unwinding those rate hikes as well. What would prompt them to say, yeah, we absolutely need to. We must move now?
Yeah. I mean, we know from Chair Powell on Wednesday that they did actually discuss cutting rates at Wednesday's meeting. We'll see in the minutes maybe how many Fed officials were leaning that way. Of course, they did then get consensus to hold rates steady on Wednesday. But yeah, some Fed officials were already maybe getting a bit anxious to start lowering rates. Maybe if this week's meeting had come just a week later, they would be thinking about a cut, at this meeting. But of course, that's not what happened. The calendar didn't work out that way. But yeah, I think they might feel like they're a bit behind the curve once they start.
Yeah, I think late to the party is a perfect analogy.
Maybe it is.
I think you're definitely right on that, Scarlett. Veronica, if the market starts to really price in the 50 basis points, right, just look at that move in the 2-year and how fast we came down today, does that then, of course, do the Fed's job for it? And then do they have to actually walk back the market?
Smart question.
So it's an interesting dilemma that Fed officials have. Yeah, we are pricing something like 42, 43 basis points for that September meeting. So we have gone a long way to pricing 50 basis points. Right now, though, the Fed has this issue where if you don't deliver on that is tightening financial conditions. And we've actually already been getting a tightening of financial conditions with equities, catching on to softer economic data, the decline we've seen over the last couple weeks, especially end of this week. That's a tightening of financial conditions into a weakening labor market that the Fed is not going to be very comfortable with. So you almost do have to deliver at that point.
Okay, but if until then we start to see bond yields continue to come down, doing some of the Fed's work for it, who does that benefit, that idea that market rates come down but the Fed's benchmark rate stays where it is? And who does it not benefit?
Yeah, I mean, in terms of, the actual rate channel to the real economy, it won't be the benchmark, policy rate that will matter a lot. It will be things like 10-year yields. We've seen for a couple weeks now, where 10-year, longer term treasury yields have been coming down, mortgage rates coming down. Something like the housing sector would be an immediate, more immediate benefit to that. But we've actually seen mortgage applications that are filed for home purchases coming down still. It will be interesting to see if any of that housing activity gets somewhat of a boost, but that seems like a genuinely weaker sector. So it might take some time before lower rates actually do stimulate activity. It obviously took a lot of time before higher rates weighed on activity.
All right, Veronica Clark, really appreciate your joining us. Citi's Veronica Clark, thank you so much. Of course, changing her call here for what she expects the Federal Reserve to do. She's been up since 5:30 this morning because she did talk to us on Bloomberg earlier today, and she closes out our coverage as well.
I mean, we'd like to round trip it for you guys.
No, but like on a day like today where so much has happened and there's a rethink of everything, it makes sense.
It's a big rethink. And not only that, but I feel like all the Wall Street banks also lowered their neutral rate. So it means the Fed has to cut even more. So that higher for longer narrative has also shifted. So like a real fundamental tectonic shift in how we're viewing
just got a lot more interesting, or whatever comes of it next week.
Did it? Okay. Now we're going to parse through all the words and yada, yada, yada. But anyway.
Back to the future. Coming up, we've got the top three where we focus in on the top three movers and shakers at the center of the day's big stories. This is The Close on Bloomberg. Time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up, Kamala Harris, the presumptive Democratic presidential nominee, raised a record $310 million in July, giving her the edge over Trump in the money race. What was remarkable, Alex, is small donors giving less than $200 made up 94% of the 4.1 million donations received.
I did think that was quite incredible. Just the new donors coming in and how significant that could be. I'm wondering if they're going to actually do a debate.
Yeah, that's a good question. It depends on the day that you check in with former President Trump.
That's actually probably very true.
Yeah, so it changes.
Okay, I'm watching Jamie Dimon. In a Washington Post op-ed, JP Morgan CEO pushed for private sector representation in the next cabinet. The idea being they're the guys on the ground. They know what's actually happening in the economy. Therefore, they should get a seat, a real seat at the table. Interestingly enough, I spoke to Chevron CEO Mike Wirth about just that, and he kind of agreed with it.
When we've seen business people in the cabinet, I think they bring a pragmatic understanding of the private sector into the policy discussions that occur at the highest levels in our country. So fundamentally, I completely agree with Jamie's point of view.
Wouldn't that be something?
Yeah, well, I mean, there have been a couple of administrations where that did happen. Wilbur Ross was, of course, formerly from the world of business, joining President Trump's cabinet. Jamie Dimon did say that in recent years, government leaders, and I think he means some government leaders, have often failed to engage leaders in industries. So he'd like to see more of that.
I remember talking to the oil industry when gas prices were at $5 a couple years ago, and I was asking, have the administration called you guys? And they're like, no. They eventually called them later, but it took a few weeks for that to actually happen, despite all the angst about $5 gasoline to that point.
Speaking of that, didn't Rex Tillerson serve in the cabinet? He
for
was
a minute.
Secretary of State.
Yeah, for a minute.
Okay.
Yeah.
Anyway, let's move on to our third person in the lineup, Tom Cruise. The actor will reportedly close out the Paris Olympics with a, quote, epic stunt, according to TMZ. And you know that TMZ is a good source on all of this. And this is because the 2028 Games will be held in LA. So he's going to be symbolically passing the torch. I'm told, I read, that the stunt will include skydiving to the Hollywood sign and passing it to Olympian athletes across LA landmarks.
What is happening?
He's also been seen at the Olympic Games, attending various meets and contests, along with a whole bunch of other celebrities.
Did you see the last Mission Impossible?
Which one? They all look the same.
No, he didn't. This is when Tom Cruise basically rolled off of a cliff, not rolled off a cliff, jumped off a cliff on a motorcycle, and he actually did it. Sure, he had strings and stuff, but he's definitely a thrill junkie. Come on.
Yeah. And that's going to make it to the Olympics closing ceremony. All right, we need to get back to the markets for a moment here, because big day in terms of moves, and you can see right there with the Nasdaq. Actually, the Nasdaq's not on there. It's because the stocks was more impressive in terms of the breadth of decline there, down 5.2%. There was only one gainer in that group, and really this is on the heels of a re-rating of all of big tech and their spending on AI and whether it's paying off. That rotation into small cap not holding on, at least for today. The VIX spikes up to almost 24. This is The Close on Bloomberg. know it's the second half of the Olympics when the qualifying heats for track and field begin, and that happened today at the Paris Olympics. As the new generation of athletes take to the track to mark their legacies, icons of the past are reflecting on their place in history. Icons like former Olympian Marion Jones, who won 5 medals. Once deemed the fastest woman on the planet, Jones is the only athlete to have ever served jail time for admitting to lying about using illegal performance enhancers and voluntarily returning her medals. Romaine Bostick and I had the chance to sit down with Marion to discuss her unique journey and the importance of entrepreneurship. Take a listen.
I think that all of us go through seasons in our life, seasons of regret, seasons of joy, seasons of success. And I needed, as I shared, to pause and to focus on what was important in my world. This is the time for me. I have partnered with an incredible company whereby we teach entrepreneurs the tools on how to come back from failure.
You're talking about the company Driven.
Correct.
Explain exactly what Driven does, and more importantly, for those folks who are interested in it, what exactly are they going to get by being on that platform?
Well, Driven Inc. is a company that was formed by Suzanne Evans a while back. Suzanne Evans is a best-selling author, New York Times best-selling author. We partnered earlier in the year. She coaches and mentors entrepreneurs, and I have a passion for physical movement. I'm also a trainer. I have been for over a decade, and this idea of balancing the body, the mindset, and your belief system in a way that entrepreneurs can really step out of their comfort zone and get closer to success. And it's something that we do. I train people, entrepreneurs, because everybody, especially as we age, we all know it's important. Movement is important. It helps the brain, it helps the body, it helps the heart. And it's something that I'm absolutely passionate about.
That was an excerpt of our conversation with Marion Jones, the former Olympian, alongside Romaine Bostick. Now, Marion mentioned passion. Passion is one of the main drivers attracting viewers to the Olympic Games. And the appeal of female athletes like multi-gold medalist Katie Ledecky and gymnastics GOAT Simone Biles has been steadily growing. Bain says the only way to go is up. And brands and investors hoping to capitalize off of this growth should get on board now. So joining us now with more on this is Laura Beaudin. She's a partner with Bain Company. She also leads the Bain Marketing Excellence Unit. Laura, it's really good to speak with you. Tell me a little bit about what your research shows when it comes to the public perception of the Olympics and how brands can monetize off of that.
Thank you so much for having me. It's great to be here. Yes, the research that we've done recently is very exciting. First and foremost, because it identified that the Olympics is one of the areas that Americans feel most positive about in sports. 70% of Americans feel positive about the Olympics. And it's an opportunity for us to celebrate all the tremendous stories like Katie, like Simone, that come out of the games. And what I think we're really excited about in the research is that we see this rising interest, fandom, and willingness for investors and brands to get behind that in all sorts of women's sports. What we have found is that there is growing interest by an audience that is actually pretty valuable from a brand standpoint, and lots of opportunities to get in on the ground floor.
So my question, Laura, is I'm that person who loves watching the Olympics, roots for all the amazing women who compete, and then after that I lose interest in sports. Scarlett's the opposite. She loves sports and then asks me about the Olympic people. How do you get people like me to engage with sports that then helps brands on a more consistent basis?
Well, first and foremost, we found that those who are watching women's sports tend to be actually a pretty diverse audience. They are a little younger than average. They are actually a little bit more educated and affluent, but they're also quite diverse. And interestingly, they're also not only women. So there are a lot of men in that audience as well, which make them really valuable for brands to target. And what I think we've seen is brands not only getting behind the clubs and the leagues and sort of the sport in general, but also helping to tell the stories of individual athletes like Caitlin Clark, like Alex Morgan, that then I think create a connection with folks like you who are looking to be able to celebrate the individuals as well as the sport.
And we showed a graphic earlier that mentioned how the most popular sports are all women's sports, whether it's gymnastics in the summer or skating in the winter. Why is it that women's events attract so much more attention, and I'm assuming money as well when it comes to the Olympics, than the men's events?
Yeah, it's a terrific question. And our research really did try to hone in on some of the reasons that women's sports have been underrepresented up to this point. Now, the great news is that with the Olympics this year, we actually have parity between men and women participants, which I think certainly helps, and helps to create a little bit more equality around the coverage of that. And our research also identified that the number one reason that fans are not watching as many women's sports outside of the Olympics is simply because they don't know where to find the viewing for that. And so, again, an interesting opportunity for investors to help find ways that these leagues and clubs can get their games aired so that their fans can actually find them.
So what is the strategy for brands and companies? Like what should be that strategy going forward?
Yeah. So what we've found with both the brands that we are working with here at Bain, as well as some of the sports leagues and clubs that we have relationships with, is that women's sports provide a pretty unique opportunity right now for those brands who may have not had access to being associated with a sport up to this point, because some of the larger men's sports, while they have a larger audience, are also pretty expensive if you want to go down the sponsorship route. And the other thing that's quite useful about women's sports, besides the broad audience that I spoke about earlier, is oftentimes you can find opportunities to be able to get pretty marquee sponsorships and visibility in these sports without having to pay as much right now for those sponsorship deals. And so any brand who has been boxed out of that in the past, or who really wants to be able to connect with that audience, has a unique opportunity to get in on the ground floor.
They can get in on the ground floor, but how do they maintain that momentum once the Olympics are over and we go back to the regular season of the professional sports, where it's difficult to find women's basketball games or women's soccer games on TV?
Yeah, well, I think the other exciting opportunity is to be able to get behind some of the individual athletes who have great stories to tell. As we just saw with Marion Jones, like, there are a lot of facets to athletes beyond just their successes in the arena. And brands can find ways to be able to showcase those stories and continue to create the connection with the audience even in the off season.
All right, Laura, thank you for joining us. We really appreciate it. Laura Beaudin, a partner with Bain & Company. Are you going to watch the Olympics tomorrow?
Yeah,
Simone
for sure.
Biles competing in individual events?
Yes.
Okay, all right. I just want to make sure.
No. I just couldn't do it yesterday, but I watched the women's team finals.
Okay.
And I saw the U.S. women win gold. So.
I like this reversal role for us, which never happened.
Alex is watching the Olympics with the sound down while she's prepping the show.
Maybe. Shh, don't tell
You
anybody.
knew everything.
Meanwhile, let's stay with sports. Meanwhile, you got the U.S. Soccer Federation is now set to borrow $200 million through the sale of municipal debt to finance building a new facility in the Atlanta area. Well, joining us now with more on this is Max Adler, Bloomberg News Muni reporter. Hey, Max, how did local officials in Georgia convince U.S. Soccer to actually move its headquarters now to Atlanta?
Hey now. So they offered a big package to them. They gave them $7 million in state and local subsidies. Also, Arthur Blank, the owner of the Atlanta Falcons and Atlanta United in the MLS, gave a $50 million contribution to bring U.S. Soccer down there. The organization has been looking for a new facility for like a decade now, since Jurgen Klinsmann was the manager of U.S. Soccer. Up until now, they've been training their staff and their employees at 3 different facilities across the U.S. So this centralization should be good for the sport. Most of their counterparts across the world do have centralized training facilities, and they're going to build this massive facility with over a dozen soccer fields now.
Okay, so they're selling $200 million of BBB rated revenue bonds for this project, which is good, but it's not AAA, but it's above speculative grade. It's above junk. Is the debt secured by a risky revenue stream or something?
So compared to other leagues like the USTA, which is the governing body for tennis in the U.S., That carries an A- rating with Fitch. Fitch did rate these bonds BBB, and they compared the U.S. Soccer Federation to USTA, saying that they have a less of a history of having a fan base and less of a history of stable corporate sponsorship, and that's why they rated these bonds lower. Essentially, Fitch was questioning whether the popularity of soccer in the U.S. was going to continue to increase. And if you're an investor and you believe that soccer is going to continue to grow in popularity, then this is going to be a good investment for you. But also, these bonds are structured slightly differently from other sports facility related muni deals. If you're building a stadium, you're able to back the stadium bonds with revenues that are produced within the confines of the new development. This is a training facility, and there aren't going to be a lot of spectators that are coming to see the players train. They're not going to be opening the doors to sell tickets. So they had to back it with just all of U.S. soccer's revenues. And that is why it's a little bit riskier.
Oh, that's interesting. But in general, though, does Atlanta have the opportunity to become like the hub of U.S. soccer?
They're already well on their way to becoming that. So they just hosted the opening match of the Copas. They're going to be hosting several World Cup matches when the World Cup comes to the U.S., Mexico, and Canada in 2026. And Atlanta United leads the MLS in attendance. So soccer is already very popular there. There was skepticism about whether the sport could grow in the Southeast. Two of MLS's early Southeastern teams, the Tampa Bay Mutiny and the Miami Fusion, both folded within 5 seasons of the MLS opening up. But now it does seem that soccer's appeal in that region has been proven and that the sport is only going to continue to grow. And Atlanta does seem to be a hotbed for that growth.
All right. Thanks so much, Max. We appreciate it. Bloomberg's Max Adler joining us with our Muni moment. Are we ever going to call it football, you think? Because we do it with our feet?
No,
it's never going to happen. It has its own different thing.
It's too big.
Fair enough. All right. Well, still ahead, what investors need to watch for tomorrow. That's right. Markets are closed, but still stuff is happening. This is Bloomberg.
All right, Berkshire Hathaway is set to report earnings tomorrow, and of course, we want to give you a preview of what to expect because it's not always, a normal thing that a company reports earnings on Saturday, but it is Warren Buffett, after all. He's allowed.
Right, so we have to follow that.
Yeah.
And really interesting, of course, to get any commentary after the week that we've had with unemployment, with tech earnings, with Intel, and with the changeover in the economy and sort of that bad news is bad news.
Yeah.
And as Jeremy Siegal put it earlier at the top of the 3, honeymoon's over.
That was the line of the morning, or of the afternoon, really. All right, Cathy Seifert is research analyst at CFRA, and she joins us now on what to expect. Cathy, Berkshire is such an interesting company because it's exposed to so many big industries, whether it's insurance, whether it's the railroad industry, whether it's the financial industry, banks. What are you looking for? What are you looking to hear from Berkshire Hathaway?
Oh, sure. So when they report tomorrow morning, I think there are a couple of things from an operational standpoint that I'm looking for. And the one big pivot point is how underwriting results at GEICO will fare, particularly given some of the strategic moves that Berkshire's made at GEICO to sort of improve underwriting results. We've seen results from Allstate and Progressive, and it looks like some of the really egregious claim cost inflation that a lot of these companies were dealing with coming out of the pandemic has eased. We're going to be looking for GEICO to experience that as well. I think we're also going to be looking to see what the level of demand and appetite for risk transfer is among Berkshire's reinsurance and commercial insurance businesses. And that'll also give us a little indication of the macro picture. And, as you mentioned, Berkshire is in so many different industries. They are kind of a microcosm for the broader economy. Mm-hmm. So kind of the overall, their overall results should give us an indication of the health of the broader economy as we head into the second half of 2024.
Well, I'm glad you said that, Cathy, because they also have, a rail business and looking for clues on that. What are you going to be looking for in relation to the rail segment?
The rail segment has had its share of challenges, not the least of which has been some margin pressure from an uptick in input costs. There was also a BNSF derailment. It happened after the end of the quarter, but I think we'll be looking to hear, about some safety measures there. The rail business has been sort of, so-so. It hasn't been really a really strong performer. There's been mixed pricing. The trends across the board have been sort of mixed from price to demand trends. But that is it's a good barometer for the health of the broader economy. So I think it's an important touch point.
Cathy, Warren Buffett has been selling down his Bank of America stake. He's still the biggest shareholder, but this is a long-time holding that he's had since 2011 in the aftermath of the financial crisis. He hasn't said why he's doing this. He hasn't said a whole lot. What do you think is the reason behind this?
I think there's some active sector allocation and portfolio management going on at Berkshire, and this may be a reflection of this sort of interim changing of the guard, whereby it's more than just maintaining a commitment to a company. It's assessing whether or not you have some concentration risk with an outsized holding. They've done a similar thing for Apple. So, and he's also taking some profits in both of these names. So it's actually kind of a prudent move.
All right. That makes sense. And it's not as if he's no longer owning Bank of America. It's just that he's been steadily trimming, and we got word that more happened today. Cathy, really appreciate your joining us. Cathy Seifert is research analyst at CFRA, giving us a look ahead to Berkshire's earnings tomorrow. Again, unusual because it's a Saturday. But let's look ahead, Alex, and give you a glimpse of what we're anticipating for all of next week. And obviously, one thing we should mention is we're all waiting to hear whether Kamala Harris gives her VP pick, or when she does that.
Yeah, it's going to happen. Maybe it has to happen at some point before the DNC, no?
Yeah.
Which is the week after, or at least maybe the momentum will be more specific.
There's a lot of talk about the first half of next week.
Yeah. All right. Well, one of my great indicators that I love is SLOOS, the Senior Loan Officer Survey. That's going to be coming out on Monday. That is so great to see how commercial and industrial and loans are coming out, and what the demand is for those kind of loans.
Especially with new questions about the strength of the economy, right? With the labor market under pressure a little bit here. All right. Also, earnings, Hims and Hers Health, which will be interesting in terms of demand for those weight loss drugs, Palantir, another AI play, and Spirit Aerosystems, which is being absorbed by Boeing.
Yep. All right. Also, Tuesday, you get trade balance, but really it's the earnings story that's really fun. You got Uber, Rivian, Airbnb, and Instacart. Talk about demand.
And on Wednesday, Novo Nordisk, speaking of weight loss drugs, Hilton, CVS, Disney, Warner Brothers. Oh, so we get a glimpse into what's going on at Warner Brothers. That'll be interesting.
That'll be very telling. And also Zillow. I love that. I love Zillow. I'm addicted to Zillow. All right, Thursday, you get jobless claims. Obviously, that's going to be even more important now as we go forward after today's data. Plus, you have earnings. Eli Lilly, Paramount, and Sweetgreen. How many people are paying for $20 salads?
Yeah, because of garlic steak. They added steak to get the guys in, right? That does it for us and this week. What a week it was. Balance of Power is up next. Be sure to tune into that with co-hosts Kelly Lyons and Joe Matthew. Have a great evening. This is Bloomberg, everyone.